Have you ever watched a stock just shoot for the moon and wondered, how do the pros know exactly when that rocket is about to run out of fuel? Well, they're not guessing. They're listening for a very specific, very quiet signal from the market. And that quote really hits the nail on the head. That's what we're diving into today. One of those market whispers. It's a candlestick pattern called the Bearish Harami. Think of it as the market's subtle way of tapping the brakes right before the bears might be about to slam them.
Okay, so let's break this thing down. The pattern is actually made up of two parts, and traders have a great nickname for them, the mother and the child candles. And as you'll see, visually, it tells a really clear story about a shift in momentum.
So what is it, officially? The Bearish Harami is a 2-day pattern, and it's basically a warning sign. Now, it doesn't guarantee a reversal, nothing does, but it's a huge heads up that the bullish energy that's been driving the price up is starting to fizzle out. Now, this pattern gets its name from a pretty cool metaphor. On day one, you have the mother candle, this big, strong, confident green candle right at the top of the trend. That's peak buying excitement. But then on day two, you get the child candle. It's this small, indecisive little candle, and its entire body is trapped or contained inside the body of the mother. In technical terms, we call this an inside day, and it's the very first sign that the buyers just don't have the strength to push the price any higher. But here's where a lot of people go wrong. Just spotting this shape isn't enough. Amateurs see the pattern and they jump right in. Professionals, on the other hand, know this is just one gear in a much bigger machine. They have a system, a checklist to verify the signal.
And that brings us to the core of this whole thing, the 5-point blueprint that the pros use to separate a real, high-probability reversal signal from all the random noise out there in the market.
This really is the key question, isn't it? I mean, anybody can spot a pattern on a chart, but the real skill is knowing which ones actually mean something. And this checklist, this is the answer.
All right, let's walk through this blueprint. Step 1 is all about context. The pattern is basically meaningless unless it shows up after a solid, sustained uptrend. Step 2 is the climax. That first mother candle, it needs to be a big, strong, confident green bar. Then step 3, confinement. The child candle has to be completely trapped inside the mother's range. Now, step 4 is a huge pro tip, the color shift. You really want to see that child candle be red. It shows the bears are actually starting to fight back. And finally, step 5 is resistance. The absolute best Harami patterns show up right at a major resistance level. Think of it like a historical price ceiling where sellers have shown up before. When the pattern appears there, it's a giant hint that they've shown up again.
So, we've got the theory, we've got the checklist. Now, let's get into the nitty-gritty. How does this pattern actually perform in the real world, and how do you manage the trade so you don't get burned? Let's talk hard facts for a second. This pattern is super common, but, and this is important, it's not a holy grail. Looking at data from the S&P 500, its success rate can get up to 66%, but the average return is pretty small. So here's the crucial takeaway. Think of the Bearish Harami as a yellow traffic light. It's not telling you to slam on the brakes and sell everything, but it is telling you to slow down, pay attention, and get ready for a potential stop. And this really gets to the personality of the pattern. It's so important not to confuse the Harami with its much more aggressive cousin, the bearish engulfing pattern. An engulfing pattern is like a direct knockout punch from the bears. The Harami is way more subtle. It's the story of the bulls just running out of breath. It's a quiet moment of doubt right at the very top.
Now, if you do decide to trade it, a professional plan has 3 simple parts. First, your entry. You'd only enter a short position after the price breaks below the low of that little child candle. That's your confirmation. Second, your stop loss. That goes just a little bit above the high of the big mother candle. This protects you if you're wrong and the trend keeps going up. And third, your take profit. You should be aiming for the next major support level, and always make sure your potential reward is at least double your potential risk.
Okay, before we wrap up, I want to share one last pro tip. This is the version of the pattern that gets my full, undivided attention. It's probably the most powerful variation you can find. It's called the Bearish Harami cross. This is what happens when that second child candle is a doji. And a doji, as you can see, is a special kind of candle where the open and closed prices are pretty much identical, which gives it that classic cross shape. Look, if the standard Harami is a whisper of doubt, the Harami cross, well, that's a full-on scream. It signals a complete stalemate and basically tells you the buyers have all but vanished from the market. Look, mastering this pattern takes patience and practice. But to seriously speed up the learning curve, you can find these high-probability setups across thousands of stocks in an instant using a tool like the ChartMill's Bearish Harami Screener. It does all the heavy lifting for you so you can focus on the important part, the analysis. So the next time you see a powerful uptrend, listen closely for that market whisper. What will you be looking for in the charts tomorrow?